Hello and welcome to Beyond the Charts. This is a show where we dive into fascinating charts from the world of finance and the economy, and we break down what is exactly going down. Now, if you're interested in viewing all the charts and sources that we discuss in this video, please do check out our newsletter. The link is in the description below. Now, in order to explain this a little better, let me break this down into different stories. In the first story, I'll take a look at the latest numbers that were released by AMFI and will dive deeper into some broader mutual fund industry trends. See, the Indian stock markets have hit a rough patch right now. In the month of October and November, they dropped more than 6% because investors were worried about several issues. Growth also seems to be slowing down, and many people think that stocks were priced too high. Now, adding to these concerns, foreign institutional investors have also been taking their money out of Indian markets as of late. But the thing is, despite the market's downturn, the Indian investors' confidence has not quite been dampened as much. The latest data from AMFI, which by the way is the Association of Mutual Funds in India, shows that equity mutual funds have attracted very strong investments to the tune of 36,000 crore rupees in the month of November. Now, while this number was slightly lower than October's numbers, it is still fairly impressive because investments have stayed above 34,000 crore rupees for 8 straight months now. And while money is flowing into mutual funds, net purchases by mutual funds in the secondary market have declined to the lowest in 2024. Cash held by equity mutual funds has also increased. As of November, they are holding about 1.74 lakh crore rupees in cash, which is around 5.8% of their total equity assets under management. This has decreased slightly compared to last month, and this is likely due to the recent market decline, but more or less cash levels have remained the same. Now, at this point, you might be thinking mutual funds are holding too much cash and they just can start investing and stop markets from falling, right? Well, the thing is, that's not how things work. Typically, most mutual funds maintain around 5% of their assets in cash for a very practical reason. This helps them handle investor redemptions very smoothly. And this cash buffer also means that they do not have to suddenly sell stocks when investors want to withdraw their money, which could otherwise in some cases lead to unfavorable selling prices and also impact their performance. Now, if you look at the category level data, most of the money going into equity funds is flowing into two main areas. First, investors are betting big on thematic funds. For those of you who are new to the markets, these thematic funds are specialized funds which focus on specific sectors or on themes. You can think of funds that invest only in automotive companies, banking stocks, or newer themes like green energy and infrastructure projects, for an example. The second thing that's happening is that there is a strong interest in mid and small cap funds. Now, considering the spectacular rally in mid and small caps since the year 2021, this is not surprising that retail investors are continuing to chase performance over here. Now, thematic funds have become quite popular in the year 2024 because the markets have continued to hit new highs over here. These funds have pulled in over 1.4 lakh crore rupees in the month of November, and they make up 38% of all the money that is flowing into equity mutual funds. And this, by the way, is a dramatic change from the year 2023 when investors were largely ignoring these funds altogether. Now, when markets are doing well, investors often become more confident and are willing to make more focused bets through sector and theme-specific funds rather than sticking to broader and more diversified investments. Now, with that said, let's shift gears a little bit and turn our attention to SIP inflows. See, the SIP investment story has two interesting sides right now. While the monthly numbers look strong with 25,300 crore rupees flowing in and a total of 2.41 lakh crore rupees invested in this year, there is also a worrying trend that is emerging over here. The SIP stoppage ratio climbed to 79.12% in the month of November, which means many investors are either pausing or completely stopping their SIPs altogether. And this is probably happening because of the recent market uncertainty, which has made new investors a little more hesitant to start investing and has also pushed existing investor bases to pause their investments. Now let's move further on and take our attention to new fund offers or NFOs. But before we get into that, for the sake of those people who are new to the markets, let's very quickly simplify what NFO exactly is. See, exactly like how companies raise money from the public through IPOs whenever they want to list on the stock market, mutual fund companies or AMCs launch NFOs when they want to start a new fund. Now, through these NFOs, they collect money from investors, which they invest based on the fund's specific mandate. And just like IPOs, whenever the market is doing well, there is also a big surge in NFOs. Now, the numbers this year show this exactly very clearly. AMCs have collected over 1 lakh crore rupees through NFOs up until the month of November, and they are averaging around 10,000 crore rupees every single month. But that said, as market sentiments have cooled off in the last 2 months, NFOs have cooled down as well. It's also important to take a look at where exactly this money is going. About 70% of these NFO investments have gone into equity-oriented schemes. This trend mirrors what we are seeing currently with equity mutual funds inflows as well. Thematic funds are clearly the hot favorite over here, and they have accounted for over 60% of equity NFO investments in this year, which is double of what we saw in the year of 2023. And this is not surprising at all. Let me bring back something that we discussed in a very recent episode of this particular show. Whenever something starts doing well, everyone wants a piece of the action. Nobody wants to miss a trend that is making money, and that is what we are seeing with sectoral and thematic funds this particular year. Now, while we are at it, let's also take a look at how debt and hybrid funds have performed in the month of November. See, while they still saw some positive inflows, the numbers have dropped dramatically compared to the month of October. Debt fund inflows fell by more than 90%, and hybrid funds saw a drop of over 75%. Taking a broader view of 2024, most fund categories have attracted steady investments throughout the year, other than funds that are investing overseas. These funds have been held back by the RBI's investment limit of over $7 billion US, which is about 59,400 crore rupees on mutual funds investing overseas. Now, this cap has effectively restricted how much money these funds can accept from investors. Now, while we're at it over here, let's also take this moment and break down where the funds are flowing within debt and hybrid. See, the November debt fund data shows a very interesting pattern in investor preferences. The majority of the money, which is about 57% of all debt fund inflows, went into short-term funds, particularly low duration and ultra short duration funds. Now, this makes sense in the current market environment for sure. When interest rates are uncertain, many investors prefer to keep their debt investments in shorter duration funds. These funds are less sensitive to interest rate changes, and they offer better liquidity, which makes them a safer choice when investors are not sure about the direction of interest rates. Coming to hybrid funds, multi-asset allocation funds have continued to see high amounts of inflows. These funds invest across a mix of asset classes such as equity, bonds, gold, etc. At the overall industry level, the industry's total assets under management or AUM grew to 68 lakh crore rupees, which showed a 1.2% increase despite the dip of the market. And I'll also tell you how this money is spread across different types of funds. Equity funds continue to dominate, holding about 30.4 lakh crore rupees. Their share of total assets has grown significantly from 55% in the month of November to 59.7% now. This shows how investors are now increasingly preferring stock market investments. Debt funds hold 16.9 lakh crore rupees, but their share has notably dropped significantly. From 18.5% last year, they are now at 14.8%. Now, this decline in debt fund share might be due to investors moving away from fixed income investments, possibly due to rising bank FD rates. The remaining money over here is split between other schemes like index funds and gold ETFs at 11.3 lakh crore rupees and hybrid funds at 8.8 lakh crore rupees. The mutual fund industry continues to expand its investor base, and it now serves more than 5.18 crore unique investors. But the thing is, the monthly pace of new investors joining has now slowed down. It has dropped from a peak of 12 lakh new investors in the month of July to about 7.8 lakh new customers in the month of November. But even with this slowdown, the industry's growth over the past year or so has been pretty impressive to say the least. Adding over 1 crore new investors in just 12 months, double the number of new investors compared to the same period last year, is great. Three regions, Maharashtra, Delhi and Gujarat, account for about 56% of the industry's AUM, with the top 8 states making up over 80% of it. AMFI publishes data which shows state-wise penetration of mutual funds based on per capita income and GDP of the state as well. Beyond the top 5 states, penetration levels are still very low, and that is a little concerning. Now let's take a look at the investor composition of mutual fund assets. Individual investors, which include retail investors and HNI investors, hold a majority over here, which is about 61% of all mutual fund assets. This share has been steadily increasing over time, while institutional investors such as corporates, banks, and FPIs hold the remaining proportion. Let's also take a look at how different types of investors spread their money across mutual funds over here. Individual investors strongly prefer equity mutual funds, and they hold about 88% of all equity fund assets. In fact, 87% of all the money that is invested by individual investors goes into equity schemes. But on the flip side, institutional investors dominate in debt funds, liquid funds, and money market funds. They also control about 88% of ETF investments, with the big proportion here coming from EPFO, which mainly invests in ETFs which track major market indices like the Nifty and the Sensex. Now, why this difference, you might ask? Well, look, individual investors usually tend to favor equity funds because they are typically investing for the long term, like for their retirement or for their children's education. They can definitely afford to take more risks for potentially higher returns since they have a longer investment horizon. But on the other hand, institutional investors focus more on debt and liquid funds for very practical reasons. Companies need to manage their cash efficiently. They might need money for payroll, inventory, or for other short-term business needs. They cannot just risk putting all of this money in volatile equity markets at once. A report from Motilal Oswal reveals some very interesting trends in how mutual funds are investing compared to the BSE 200 index. Fund managers are heavily favoring manufacturing and healthcare sectors while they are stepping back from tech and banking. Capital goods is getting a lot of attention, with 15 mutual fund managers betting more heavily on it than the index is suggestive of. Healthcare is equally popular, also drawing above index level investments from 15 funds. What is interesting here is how cautious fund managers are being with tech stocks. See, despite technology making up a significant 11.1% of the benchmark, 14 funds are actually investing less in it compared to the index levels. They are also staying away from private banks and oil and gas companies. 15 funds are underweight in banking, while 17 of them are keeping their distance from oil and gas altogether. Reading between the lines, it looks like fund managers are putting their money on India's growing manufacturing strength. At the same time, they are also playing it safe with sectors that tend to swing with global markets or seem expensive right now. On the broader industry level, technology stocks are gaining favor again, with their weight increasing for 2 straight months to reach 9.2%. PSU banks are also seeing increased investments, with the sector's weight climbing to 3%. This comes after hitting a low point in the month of September, which suggests that mutual fund managers are becoming more positive about government-owned banks. But some sectors are falling out of favor over here. Auto sector's weight has dropped from its June peak of 8.9% to 8.3% now. Even more striking over here is the oil and gas sector, which has seen its weight decline for 8 consecutive months now, and it is now at 5.7%. There weren't any notable changes in sector holdings of mutual funds in the month of November. Private banks continue to remain the top sector held by mutual funds, which were followed by technology, auto, and capital goods. Now let's switch gears a little bit and move on to inflation. The November inflation numbers bring some relief after 2 months of increase. Inflation dropped from 6.2% in the month of October to 5.5% in the month of November. The rise in inflation has largely been driven by increasing food prices. But if you take food out of the equation here, inflation has actually been coming down across other categories. This means everyday items and services, excluding food, are seeing more stable prices. Higher food inflation is particularly troubling here because it directly affects every household, but it hits the poorest families the hardest. For people who are living on tight budgets or marginal wages for that matter, even a small increase in the prices of food can have serious impacts on their daily lives. And when food takes up a large portion of a family's income, which is often the case for lower income households, rising food prices force difficult choices on them, like cutting back on nutritious but expensive items or reducing portion sizes. Now, unlike discretionary spending that can be postponed or even avoided to an extent, people cannot simply stop buying food. And therefore, you might be wondering what exactly is driving the increase in food prices? See, unfavorable weather conditions like heat waves, unseasonal rains, and uneven monsoon rainfall have largely affected vegetables, fruits, pulses, and cereals, and that has caused an increase in these prices. At this point, it will also be interesting to take a look at the price trend of everyday food items over the past couple of years. The most dramatic price swings have been in everyday vegetables, particularly in tomatoes and onions, which have seen sharp spikes and high volatility. Pulses and cereals, which are staples in the Indian household, have shown a consistent upward trend in prices, which makes everyday meals a lot more expensive over time. Let's also look at what's happening with edible oil. Here, the situation is a little mixed. Groundnut oil prices have stayed relatively stable within a range, but sunflower oil and mustard oil prices, after seeing some relief earlier on, have started to climb again. Essentials like milk and sugar have remained relatively stable, while tea prices have been fluctuating. Let's now switch gears once again and talk about the Consumer Confidence Survey. See, the Reserve Bank of India conducts a Consumer Confidence Survey once every 2 months to understand how Indian households are feeling about the economy. Their latest survey from the month of November 2024 offers insights into people's views on everything from their income and job prospects to inflation and even their spending habits. When it comes to the current situation, confidence has slightly weakened down. The current situation index, which is also called the CSI, has declined from 94.7 in the month of September to 94.0 in the month of November. This is suggestive that compared to last year, fewer people are believing that there have been improvements in key areas like jobs, income, and overall economic conditions. But the story changes dramatically when people look to the future. The Future Expectations Index, or the FEI, actually showed a small increase and moved up from 121.4 to 121.9. This shows that despite all these current concerns that we have today, Indians remain optimistic about what lies ahead of us. We anticipate more job opportunities opening up, expect our incomes to rise, and believe that we will have greater spending power in the coming few years. Now, like I said, the RBI survey breaks down consumer sentiment across jobs, inflation, income, and spending. Let's see what people are saying about each of them. First, let's take a look at jobs. Look, right now, fewer people believe that employment opportunities have improved. The net response have dropped slightly to 7.8%, but the future looks brighter over here. People expect job opportunities to increase with the future net response rate improving to 28.1. But inflation still continues to worry Indian households. An overwhelming 94% of the respondents said that prices have risen over the past year. Unfortunately, though, they don't see much relief coming. The future price level response remains deeply negative at minus 73.8, which is suggestive that most people expect prices to keep rising in the future as well. Now, when it comes to income, people feel that their current income situation has not improved too much either. Though that said, they are still very hopeful about the future. A majority, which is about 56% of households, believe that their income will increase in the coming few years. Coming to spending, a significant majority of about 81% of households reported spending more on essential items compared to last year. Now, this is not surprising at all given that the food inflation situation is bad as we discussed earlier. Now, the interesting part is that despite higher spending on essentials, there is also a slight improvement in non-essential or discretionary spending. This suggests that while some households are dealing with higher costs for basic needs, they still have some capacity remaining for other purchases. That's all for today. Thank you for watching. I hope you enjoyed this show and learned something new from it. Please do share your feedback in the comments down below and we would love to discuss this in detail with you. As usual, this is your host Anurag Bansal signing off. Take care and I'll see you in the next one.